And good day, everybody. Connor McIver here. Let's talk a little bit about lending. And again, we do not do loans, but this will be a really good guide with some of the run-ins that we've had in the past with our clients seeking out their own lenders and lenders that Paris and I work with. So let's go ahead and get started, and let's see where this gets us. A few things about lending and what you need to know. There are a few first steps before you actually jump into purchasing a home, and let's get a few definitions out there. Pre-qualification is typically going to be something that's going to be telephonic. Pre-approval is something that's a little bit more strict. They're going to be looking at loan documents for taxes and also documents as far as paycheck stubs, and then we'll also cover what the underwriter approval is. For the first one, let's go ahead and go into pre-qualification. Now with that, that's typically going to be a telephonic, or you could be doing it on the internet. At that time, they're not going to require any type of supporting documents, so your tax returns and paycheck stubs or something, they're going to just basically take your word on. And again, it's a verbal assessment. This is a very preliminary step. This will give you an idea of where the numbers are and possibly what you can afford. But again, it's not all said and done until the lender actually looks at the next phase, which is going to be pre-approval. And this is in person is always best with everything. Even with our team, I want my clients to sit in front of me unless they know me, but telephone is okay, but you can't get a good look at somebody unless you're sitting in front of them. So it's difficult to see that part of it. They're going to require for pre-approval, you're going to need to give them copies of pay stubs, probably also bank statements. They're also going to want to look at a couple years worth of tax returns. There's been a lot of changes in lending lately where they're asking, the government is now saying whatever you're writing off, they're going to go ahead and take that off of what you can actually qualify for. So just something to think about. That was something that came about this year, actually the end of last year, which is 2009, and that was creating a lot of problems for a lot of our clients that figured that they were able to qualify for more, but because they did have so many write-offs, they could not qualify for as much with that change. They're going to also want to know your current monthly bills, and it's definitely the most complete part. There's a final step that typically is after you already have acquired a target property, a property that you've entered into contract on, and that's going to be your underwriter approval. Some of the internet companies out there that don't really have a home office besides the internet, they do generate internet UAs, but again, those aren't looked at as being very serious in comparative to when you actually have it done by a bank. When you're talking about this, the generated UA documents, to get those directly generated is actually always better. When in a direct lender, they are the ones that are giving this authority or the UA approval, the underwriter approval. So that's coming right from the source. So there is no middleman. The documents don't get changed. They don't get modified. They are actually from the source. Couple of things that you want to know when you go visit a lender, be it somebody we recommend or somebody that you already bank with or know. A couple things that I would ask for if I was in the market for a loan. I would want to get copies of my credit report as I walked out of my lender's office. It's nice to have that with you. You're also going to want to get good faith estimates, and I say more than one. A slide here in the future is going to give an example of why that's important. But again, good faith estimate is basically how the lender is going to structure the loan, the estimate of an interest rate based on today's numbers, and again, that's going to fluctuate up and down as time goes on. We just had a recent drop of a few tenths of a point, but again, next week it could be a little bit higher. And again, sometimes they might tell you that you need a property identified that you're going to write an offer on. That's not necessarily true. Just give them an obscure number. If they're telling you that you qualify for $500,000, I would want one at 500 and maybe one at 400, just to kind of see an idea what the difference is in payment. Here's a few speed bumps we do come across. A lot of people that are out there looking for loans. Lack of credit is one. You haven't financed anything in a while, or credit cards are sitting and they're not moving at all. That might be a sign from the bank that's generating this approval letter that in fact you don't have enough credit. Bad credit, of course, is going to be being late on mortgage or regular payments, credit card payments, car payments, or having something on your credit that you're not aware of, which happens from time to time. Also, you might be paying out too much on a monthly scale. That's going to increase something called DTI, or debt to income ratio. It's going to place that number too high. So basically what you're bringing in, there's not enough left over to be able to have the ratio in such proportion where they're going to loan you money. And also, one of the newer things, if you are a current homeowner and you're looking to move away and you don't have enough equity, let's say, in your home to sell that home currently with this current market, that might be something they're going to look at. They'll definitely ask a question if they see a mortgage payment currently on your credit. Hey, what are these folks up to? What are they doing? Are they going to basically purchase another home and then walk from this one? Or are they going to be able to rent it out? There's a lot of questions that they might ask. But with these, you can definitely fix it. One of the remedies, of course, is establishing credit, piggybacking on somebody's credit card, mom or dad or somebody else. You can also fix credit yourself. We have resources for that also if you'd like to pay somebody to do it by inquiring into the credit bureaus for things that aren't yours, or things that they told you that they were going to remove if you made good on it, but they did not. Of course, if your debt to income ratio is too high, you can pay off bills, and of course selling of a current home is an option if the mortgage is limiting you from getting another residence. As far as knowing what you can afford versus what you can qualify for, this is so very important in real estate. We have, at one time, back when stated income loans were the bee's knees and the thing to do, we would have people that qualified for huge amounts of money because they were never asked really what they made. And today that doesn't happen as often, but I would throw caution to the wind with every buyer out there. If somebody's telling you that they can qualify you at $500,000, you need to know what that payment is at $500,000. You need to sit down and discuss it. When you're sitting there talking about homes and payments, you want to sit there and you want to find out the A to Z of it, and you also want to discuss this with your family or whomever else is in your life. If you're all alone, then sit and have a conversation with yourself, but you do need to make sure that whatever you're going to be purchasing isn't going to stretch you to a point where you become something that Barris and I call mortgage poor. It's very painful, and it's just terrible, terrible to be involved when every month you're writing that mortgage payment, swearing up and down you wish you wouldn't have done it. Some sage advice. Here's a recap. Again, you want to work with a reputable lender. You want somebody that is known, and of course the mainline banks are all well known. But again, in the lending world, there are two different types of lenders. You have the direct lender, which is going to be your Wells Fargo, Bank of America, the mainline banks, and then mortgage brokers. There are advantages to each one. It just depends on what system you're going to fit best within. It's not always the case that mortgage brokers are more expensive. In fact, sometimes they are a better fit for some, and vice versa, direct lenders. It's always good to hit both up when getting pre-approved and pre-qualifying, finding out what kind of programs they have. Are there any special first-time buyer programs? And if in fact they're stating that there are, I would want those on paper. Don't take anybody's word for it. You need to find out really, truly, what is the advantage to using them. Another thing too, you're out there picking a real estate agent. They might tell you, hey, I have a great lender. Well, that's great, and you can use their lender, but you also kind of want to find out what kind of relationship is there that exists. As far as I'm concerned, we can only vouch for our clients. We do recommend people, but again, bottom line is you need to feel comfortable. And also, as far as our relationship goes, we don't have any with anyone. As long as they take good care of our clients, we'll continue to recommend them. If they ever hurt anybody in any way, we will never recommend them again. So that's our philosophy on that. Thank you so much for watching. We do hope to serve you well when you're ready. We are RE/MAX of Santa Clarita's Paris 911 team. We can be reached here, and it was fun. Have a great day, and we'll talk to you soon.